Monzo, the digital banking app-based giant, have made a groundbreaking move in launching investment funds for their 8 million customers. They have 3 awesome funds available for investors of all risk appetites. And in this video, we're going to break down how to set up your Monzo investments for long-term success in 3 easy steps. From helping you choose the right investment account for you, to providing guidance on what fund best suits your needs, to the final step of putting together a payment plan to set up your investments for long-term success. Monzo's features make this process super simple and easy, so even if you've never invested before, you'll be in safe hands. And as we go through the video, you'll see just how easy Monzo makes it to start your investing journey. However, if you're looking for a broader overview of Monzo's investment proposition, I have another video for this, and you'll find a link in the description below. And if you're new to the channel, I'm Alex, a management consultant by day, and on this channel we like to talk about all things finance with particular focus on how to grow your money. And if you haven't already, I'd greatly appreciate a subscribe, as it will help me grow my channel. So let's get into it, and let's bring up their app so we can go through the process together. And before we start step 1 of choosing the right investment account for you, we'll need to navigate through a few screens on Monzo's app to find the investment proposition, the investment features. So we're going to click on investments, we're going to click start investing, and now Monzo's asking me a couple of questions just to make sure I'm suited to investing. So they ask me first, are you relying on short-term borrowing? I'll select no. And then they ask me, do you have enough set aside for emergencies? It's important to have an emergency fund, a sufficient emergency fund, before you start investing. As if the worst case scenario happens, an emergency happens, and you need money, you may withdraw money from your investments at a time you don't want to and end up losing money. So it's very important to have an emergency fund before you start investing. So I'll select yes here, and now Monzo is letting me know, let's open your pot. I passed those 2 questions. And now we're starting the first step of the investing journey in choosing your account type. So you have 2 account type options, either a stocks and shares ISA or a general investment account. And I would recommend a stocks and shares ISA, as this option provides a tax-free wrapper where you won't pay any tax on the money you make in this account. To put it simply, you keep everything you earn from your investments after all charges and fees are taken. In terms of how much you can put into a stocks and shares ISA, in this tax year, your ISA allowance is £20,000, 20k. So you have an allowance of £20,000 you can put into this ISA account. And it's also worth bearing in mind that that 20k is a combined annual allowance for all your ISA accounts. So if you have any other types of ISAs open in the same tax year, you can only put in a combined total of £20,000 for all those accounts. So to sum up these accounts, the Stock and Shares ISA is the best option from a tax saving perspective. But if you already have a Stock and Shares ISA open with another provider, and if you're not willing to transfer it to Monzo, or if you're already maxed out your ISA limit, your ISA £20,000 limit, then a general investment account will suit, and that will work as well. So the first step in your investing journey in choosing your account type is very simple. You have a choice of 2, and for most people, a stocks and shares ISA will suit. And for the purposes of this video, as an example, I'm going to select open general investment account, as I've already got a stocks and shares ISA open with another provider already, and I don't want to transfer it to Monzo. So I'll select open general investment account, I'll select continue, and now we're on to step 2 of the investing journey, stage 2, in choosing your fund. And this is the most important step, in my opinion, of your investing journey, as this decides where your money goes. You need to make sure you choose a fund which best suits your needs. So let's go through the funds first to provide an overview of them, and then let's go through the considerations which will help you choose which fund best suits your needs. But before we do that, we can see Monzo here on this screen is letting us know some information about the funds, that they're coming from BlackRock. They're BlackRock funds. BlackRock are providing Monzo these funds, and Monzo also letting us know how they chose these funds. And there seems to be 2 primary reasons to why Monzo chose these funds from BlackRock. Firstly, that they're diversified, extremely diversified across the world, and secondly, that they have your values in mind, which seems to mean that the funds are environmentally friendly. In the text there, we can see that each fund aims to invest in a way that's better for the planet. So it suggests these funds are environmentally friendly, they're ESG friendly. So let's select next, and now we can see the funds available. So let's go through each of those funds. So we have Careful, we have Balanced, and we have Adventurous. Careful is lower risk and reward, Balanced is medium risk and reward, and Adventurous is higher risk and reward. So let's click on these components and find out a bit more about the funds. And let's start with Careful. So if we click on Careful, we have some projection information here. If we go down, we can see what is the aim of the fund. And the aim of this fund is, the fund is designed for you to invest for at least 5 years over that time it aims to give you a return on your money, taking a certain level of risk to do so. And we're most interested in what the fund is invested in. So let's click what the fund invests in, and let's scroll down, and we can see here the fund is mainly invested in bonds. So 80% bonds, 20% shares. So this explains why it is called the cautious fund, because bonds are typically a lower risk and more stable asset compared to shares, but also because they're lower risk, they typically have lower potential returns. If we scroll down again, we can see there's more information about the fund. It lets us know that the fund invests in 30 other funds, which hold over 48,000 assets. So this tells us the fund is extremely diversified. If we scroll down again, we get the regional breakdown. You can see that this fund is mainly invested in North America, followed by Europe, followed by Asia Pacific. So now we know a little bit about careful. Let's move on to balanced. So if we click on balanced, again we have this projection information, but we're most interested in what the fund is invested in. So here we can see that the fund is invested 66% in shares and 34% in bonds. So this fund is more heavily invested in shares and less so in bonds. So there's a big difference with the careful fund compared to the balanced fund. The balanced fund is invested more in a risky asset, but that also gives you the potential of higher returns. If we scroll down, it's similar in terms of the amount of funds it's invested in, the amount of assets, and in terms of the regional breakdown, there's a slightly higher percentage weighting towards North America. If we go back and look at the final fund, Adventurous, and skip through this projection information, go to what the fund is invested in, there's no surprise here in that this fund is 100% invested in shares, is 100% invested in a risky asset, a volatile asset, which also offers potential higher returns. Given the name is Adventurous, there's no surprises what this fund is invested in. And if we go down, we can see that this fund also invests in around 30 other funds. So there's a common theme with the cautious, balanced and adventurous funds, and that they're very diversified, and they all invest in around 30 other funds and hold plenty of assets. They all hold over 40,000 assets. And if we look at the regional breakdown, we can see again North America dominates this fund, followed by Europe, followed by Asia Pacific. And if you want to deep dive even further into exactly what each fund is invested in and the country by country breakdown, then I have all this information in my other video going through the Monzo investment proposition. We go through each fund in a lot of detail into exactly what each fund is invested in. So check the link in the description below if you want to have a deeper dive into these funds. But now we have an overview for this video on each of these funds, what they're invested in. We can discuss some considerations into what fund best suits you. Of course, there's plenty of different factors which will impact people's decisions, but let's keep it simple and let's look at the two main factors which will help most people decide which fund is best suited to them in time horizon and risk level. Understanding how much risk you can take is the most important factor when investing, as typically the higher the risk, the higher the potential return you can get from the investment, but also the higher likelihood you may lose money with the investment. And with these funds from Monzo, the risk logic is no different, as it's clear that the Adventurous fund has the highest risk level, but also offers the highest potential returns compared to the balanced and careful funds. And of course, everyone wants the highest returns, but not everyone will be suited to this Adventurous fund, as they may not be able to accept the level of risk which comes with that, the level of risk of losing your money with the Adventurous fund. So you may now have the question, well, how do I know how much risk I can take? And this is where time horizon comes in, as time horizon is extremely important in determining how much risk you can take. So let's dig exactly into what we mean by time horizon. Time horizon essentially means how long you can expect to be able to keep your money in the investment without needing to withdraw. And the reason this is important is because the longer you can keep your money in the investment, the longer you have to keep your money in the investment without needing to withdraw, the more risky a fund you are typically suited to. And on the other side of the coin, the less time you have to keep your money invested, the less riskier fund you are typically suited to. And the reason for this is because riskier funds, such as the Adventurous fund in this case, are mainly invested in stocks. We saw the Adventurous fund was 100% invested in stocks. And stocks are very volatile in the short term compared to bonds. They go up and they go down a lot. And this means that if you need to withdraw the money in the short term, you could face the market having a bad year and face making a loss, ending up with less than you started with. This means that riskier funds, and in this case the Adventurous fund, is not suited to individuals who need to withdraw the money in the short term, individuals with short term time horizons. One of the main reasons that investors lose money is investing in stocks and not leaving money there long enough, or not being able to leave money long enough, and then withdrawing the money in a time period where the market has a bump, where the market has a negative spell, and they end up with less than they started with investing this way. However, over the longer term, the stock market tends to do well. Over any 10-year period, the stock market tends to make positive returns, which outstrips the best yield, the best interest rates you can get with savings accounts. And the reason they tend to do well over the longer term is because this time frame gives investments long enough to ride out any bumps in the stock market and make a positive return. And this logic is reinforced by plenty of research out there by many different organizations. For example, a 2019 Barclays study found that shares do better than cash 9 times out of 10 over any 10-year period. And what this really means is that over longer time periods, you can typically take more risk as you have more time to ride out any market bumps. And you probably get the picture of what this means for Monzo specific funds. Over a shorter time period, let's say around 5 years, the cautious fund will suit. Over a medium time period, let's say 5 to 10 years, then the balanced fund may suit. And over a longer time period, a longer time horizon of over 10 years, then the adventurous fund may suit. However, the buck doesn't stop here, as your decision shouldn't just be based on time horizon, as the fund you pick should ultimately align with your risk level, how much risk you want to accept, how much risk you're willing to accept, and time horizon isn't the only factor affecting your risk appetite. Other factors can also impact your risk appetite, so just have this in mind. For example, you could just be a risk-averse type of person, or you could be a type of person who makes emotional decisions, which means you're prone to selling investments when markets experience a bump. And in these cases, you probably don't have a high enough risk tolerance to be suited to the adventurous fund. Your risk tolerance is probably quite low in these cases, and you may be suited to the cautious fund, even if you have a long-term time horizon. Other factors apart from time horizon are impacting your risk level here, which means you're not suited to the highest risk type of funds. So hopefully this makes sense, and what may help is going through the risk level associated with each of the funds and discussing what type of person is suited to each of those funds, what type of person is associated to each risk level. So let's do that next, and let's start off with the cautious fund. This is the least risk given it has the highest amount of bonds. 80% of the fund is invested in bonds compared to 20% in stocks. So this type of fund will suit people who want to give their money a chance to grow faster than in a savings account, but also have a priority to avoid a loss. So for example, this may suit someone who is nearing retirement, as these types of individuals want to make a return higher than savings account interest, but may not have the time to recover from any losses they would take. So they want to avoid a loss as a priority. They've got short-term time horizons. If we move on to the next fund, in balanced, this is the medium risk fund out of the three, given it's a balance of stocks and bonds at 66% stocks and 34% bonds. And here, this fund is suited to those looking for growth, but equally want to limit unpredictability. So for example, if someone is looking to save up for a house deposit over a 5 to 10 year period, in this case, they want growth. They want that house deposit fund to grow, but they don't want to place too much risk on their house deposit, given the importance of it to their life. It enables them to buy a house, a huge moment in anyone's life. So the balanced fund suits these types of individuals. The last fund in adventurous is the most risky fund of the three. It's 100% invested in stocks, and this fund suits individuals willing to take more risk to chase higher returns. And typically this fund suits individuals with a long-term time horizon, and this usually means young individuals, as they tend to have high risk appetites and long-term time horizons. So hopefully now you know which risk bucket you fit into and which fund will best suit your needs. And this means we can move on to the final step in the investing journey. But before we do that, it's worth saying that with each of those funds, the fees are the same. You have a 0.14% fee to BlackRock for the fund, and then there's a 0.45% fee to Monzo as a platform fee to benefit from using Monzo's app to invest. So the fees are the same for all three funds. And for the purposes of this video, I'm going to select the adventurous fund, as I have a long-term time horizon, I'm willing to take more risk, and I'm quite young, so this suits all my needs. So I'm going to read through now all the information associated with this fund, and once I've read this, I'll click accept and create pot. And now Monzo have created my investment pot for the adventurous fund, and now we only have one step left, the final step left of the investing journey, in step 3, in choosing how we want to pay into our investment account and how much we want to put in the investment account. And this is a very important step in setting up your investments for long-term success, ensuring consistency and ensuring commitment. And here, like with the other steps, Monzo keep it really simple. you have two options of paying into your investment account. You can do a one-off investment. You can also do a regular investment where a fixed amount goes into your investment account and is automatically invested into your fund over a time period of your choosing. So here at the top, we can make a one-off investment, and the minimum investment level for Monzo is just £1, which is great. It makes it super accessible. And we can also select where we want to fund the investment from, which Monzo account we're using to fund our investments. So let's input just £1 here to kick off this investment account. It's worth putting out that you need to make a one-off initial investment to kick off your account before you can use the regular investing feature. If we tried to regular invest without doing the one-off investment, it just won't allow us. So I'll just input the minimum required amount for the one-off investment to kick off the account. Then we can go below to regular investing, and here we can select the amount we wish to regularly invest. I'll select £100. And then we can select how often we want to regularly invest, the cycle of investments. And Monzo gives us a few options. We can invest every week, we can invest every 2 weeks, every 4 weeks, every month, every quarter, or every year. So there's plenty of options here. I'll put every month to align to payday. And then the last step is to select the start date, and I'll keep this as it is. And with this approach of drip feeding a fixed amount over time, it's known as pound cost averaging or dollar cost averaging for the folk in the US. And even if you have a lump sum to invest, it's often wise to adopt this approach, as although investing a lump sum will get your money working immediately, if the market dips, that whole sum will be exposed to the fall. Whereas with the drip feeding approach, it smooths out the highs and the lows of the market. You buy at the top, you buy at the middle, you buy at the bottom of the market, and ultimately receive an average market price rather than taking the risk of buying at a market high point. So for this reason, dollar cost averaging, pound cost averaging is often a wise approach. And if you want to use this drip feed approach, it also makes sense to do so using Monzo's automation features. So money is ultimately taken from your Monzo bank account and then placed in your Monzo investment account over a regular time period. And the benefit of doing so is that it saves you a whole lot of time from needing to manually transfer money to your investment account. And this approach also takes away a lot of the stress associated with investing, and it takes away a lot of the emotional biases with investing, which can typically cloud judgment and lead to worse performance. For example, in a month where the market is performing badly, you won't be tempted to not invest, as you won't have to physically go through the process of topping up your investment account and then funding your investment. Similarly, if the market is doing extremely well, you won't get drawn into investing too much and overcommitting. So for most people, a drip feed approach using automation works. It's their best option for investing. And for example, myself, I use the drip feed approach. I invest using automation features every month. Every month, money is taken from my bank account to my investment provider and automatically invested in my chosen funds. And this takes away all the emotion from investing and helps you remain consistent in the long term. And consistency is very important for success and positive returns in the long term. And that finishes off step 3 of the investing journey. And hopefully you now have some guidance into how you can invest with Monzo, how you can set up your investments for long-term success. We've gone through the first step of choosing the investment account suited to your needs. We've gone through the second step of choosing the fund suited to your needs. And we've gone through the third step in putting a payment plan in place for long-term success. So hopefully you'll now be on your way to a positive investing journey with Monzo, or just have a little bit more information about how you could do so. If you want to deep dive into more information about the funds, a breakdown of what the funds are invested in, then I have another video for that. You'll find it in the description below. You'll find a link in that description. And I'm also going to produce more videos regarding Monzo's investments. I'm going to do monthly updates on how my own Monzo fund is performing. I'm going to fund it £100 every month and do a video about the performance. So keep an eye out for that. Thanks guys.